Every day we make decisions that shape our future, but some choices echo louder than others. There are 3 vehicles that can carry you toward financial freedom. But which one fits you? Stocks? Mutual funds? ETFs? You clicked this video because you're not average. You're driven. Maybe you've started your career. Maybe you're building your business. Or maybe you're just done sitting on the sidelines. Welcome to part 3 of our Investing Basics series. And today, we're unlocking the real difference between these 3 investments and which is right for you. I'll tell you why this video matters. Because 5 years ago, I stood exactly where you're standing right now. Confused, overwhelmed, yet hungry. I didn't grow up with money talk at the dinner table. I had no finance degree. But I knew one thing: I didn't want to work forever. And when I looked up investing, I was hit with a wall of jargon. Index funds? Expense ratios? ETFs versus mutual funds versus stocks? It felt like learning a foreign language. So today, I want to give you what I didn't have. A clear, human explanation of what each option actually means, and how each could change your life. Let me paint a picture. Imagine you're planning a road trip across the country. You can choose between 3 vehicles: a sports car, fast, thrilling, but demands your full attention; a tour bus, comfortable, driven by someone else, steady and safe; a smart hybrid sedan, balanced, efficient, and you're in control. These are your investment choices in disguise. 1. Stocks are the sports car. 2. Mutual funds are the bus. 3. ETFs are the hybrid. Each can get you to your destination, but depending on your style, your time, and your risk tolerance, one might fit better than the others. So let's decode these in plain English. Stocks are shares of ownership in a company. You buy a piece of Amazon or Apple or Tesla, you're literally a part owner. If the company grows, your share grows. But if it falls, you feel it. Mutual funds. Mutual funds are like big group tours. A professional fund manager decides where to go, what to buy, what to sell. You buy into the whole package. ETFs, exchange-traded funds. ETFs combine the best of both worlds. Like mutual funds, they hold many investments, but they trade on the stock exchange like stocks. So you get flexibility, diversification, and usually lower fees. Let me tell you about Sarah. She's 26, works in marketing, hustling hard, trying to save up for a down payment and eventually freedom from the 9-5. She had $3,000 to invest, and she had a choice. Her brother told her to buy Tesla stock. Her dad said to try mutual funds. A friend swore by ETFs. So she split it. 1. $1,000 in Tesla stock. 2. $1,000 in a mutual fund. 3. $1,000 in a tech-focused ETF. 4. Her Tesla stock doubled, then crashed 40%. 5. The mutual fund grew steadily, about 8% by year-end. 6. The ETF? 6. It mirrored the tech sector, up 12% with less drama. Sarah learned what you're about to. Each vehicle plays a role. The real power comes from knowing which one to use and when. Let's go deeper. Each of these options has incredible upsides, and a few downsides you need to know before you commit. We'll start with stocks. Stocks are like jet skis, agile, powerful, exciting, and prone to tipping over if you're not careful. Pros. 1. Highest growth potential. Individual winners can 10x your investment. 2. Direct ownership. You have a say, sometimes literally with voting rights. 3. Dividends. Some companies share profits regularly. Cons. 1. High volatility. Stocks can tank without warning. 2. Requires research. This isn't a Netflix binge. 2. You need to know your companies. 3. Emotional roller coaster. Greed and fear are powerful forces. If you want control and love a challenge, stocks might be your playground. Mutual funds. The cruise ship. Mutual funds are the cruise ships of investing. You're not steering, but you're enjoying the ride. Slow, steady, and managed by pros. Pros. 1. Professionally managed. Sit back while analysts steer. 2. Diversification. Spread across dozens or hundreds of investments. 3. Convenient for retirement accounts. 401k. 3. IRA. 3. They love mutual funds. Cons. 1. Fees. Management doesn't come cheap. 1. Look for the expense ratio. 2. Less flexibility. You can't buy or sell instantly. 2. Only at day's end. 3. Can underperform ETFs, especially after fees. ETFs. The smart compromised ETFs are built for our generation. Efficient, customizable, and tech-savvy. Pros. 1. Low fees. Most charge under 0.10% per year. 2. Trade like stocks. Buy or sell whenever the market is open. 3. Instant diversification. Own an entire sector or index with one click. Cons. 1. Market exposure. Still affected by economic swings. 2. Some complexity. With thousands of ETFs out there, choosing the right one can be tricky. 3. Tracking error. Some ETFs don't perfectly match the index they aim to copy. Let me tell you about James. He's 33, runs a small digital agency, and hates wasting time. His motto? Make money while I sleep. He used to invest in individual stocks, but the late-night Reddit scrolls, the news alerts, the stress, it got to him. One day he lost $2,000 on a single earnings call, and it hit him. So he pivoted. Now he automates his investing. 1. A portion of every invoice goes into an ETF that tracks the S&P 500. 2. Another chunk goes into a low-cost mutual fund in his Roth IRA. 3. And he keeps just 10% in stocks, for fun, not survival. James found peace. His portfolio performs well. He sleeps better. That's the power of matching your investing vehicle to your lifestyle. DIY Dana. 1. Loves reading annual reports, financial news, and analyzing trends. 2. Wants control and thrives on challenge. 3. Dana ill stocks. Busy Ben. 1. Has a demanding job and little interest in markets. 2. Wants simplicity and expert guidance. 3. Benny mutual funds. Balanced Bree. 1. Wants to grow wealth without too much stress. 2. Likes the idea of diversification and low fees. 3. Bree L ETFs. Which one are you? Or maybe you're like most people, a little bit of each. That's okay. The truth is, most smart investors blend all three. Let's have a real moment. Investing is personal. It's tied to your beliefs, your fears, your goals. It's not just money, it's meaning. When markets crash, it's not charts that panic, it's people. When your investments grow, it's not digits that celebrate. It's you planning that trip, retiring your parents, funding your dream. So don't just pick an investment. Pick a path that reflects who you are and who you want to become. All right, time to turn this from education into action. Your 5-step challenge. 1. Pick one stock, one mutual fund, and one ETF to research this week. 2. Write down your 5-year financial goal. 3. Open a brokerage account if you haven't yet. 4. Invest as little as $50. 4. It's not about the amount, it's about starting. 5. Comment below, which vehicle do you connect with and why? Your future self will thank you for today. Because when you take control of your money, you take control of your story. Imagine I handed you this Lego set. It's beautiful on the box, your dream financial future. But now imagine I gave you the finished toy instead. All built. Just done. Not satisfying, right? That's because we love the building. We love taking the pieces, stocks, ETFs, mutual funds, and fitting them together to create something uniquely ours. This is what your investment journey is. A Lego puzzle that only you can solve. Let me tell you about Lucas. He was 29, brilliant, a data scientist obsessed with perfection. He built a spreadsheet that could rival Wall Street's best, and then he froze. For 18 months, Lucas never invested a single dollar. He analyzed, overanalyzed, second-guessed every decision. By the time he finally moved, the market had already run up 20%. His perfect plan was now behind. His lesson? Action beats perfection. Even a pretty good plan, executed today, beats a perfect one never used. Don't wait for the perfect moment. Start. Learn. Adjust. That's how wealth is built. If you invest $100 a month starting at age 22 with a 7% return, by 60, you could have over $250,000. If you wait just 10 years, that number nearly halves. Time is the most powerful force in investing. It beats talent. It beats luck. And the best part? You already have it. But it's slipping away every day you wait. You may not think of yourself as an investor yet, but the moment you put your money to work for your future, you are one. And here's what investors believe. 1. Long-term thinking wins. 2. Simplicity is powerful. 3. Learning is never done. 4. Fear is a compass, not a stop sign. This isn't just about building a portfolio. It's about building a version of you that is confident, patient, and unstoppable. I want you to take 5 minutes today to do this. 1. Write down where you want to be in 10 years. 2. Then answer this. What role will investing play in that journey? Stocks, ETFs, mutual funds. 4. And finally write, I am becoming an investor. This is your moment, your time, your path. In the next and final part of this series, we're going to build your actual investment plan. We'll talk about 1. Setting up your first portfolio. 2. Choosing your allocations. 3. Automating everything, so your money grows while you sleep. Make sure to hit subscribe, drop a comment below with which vehicle you're exploring, and share this with a friend who's ready to take control of their financial future too. I'll leave you with one final story. A young woman once came to me after a workshop. She was 24, living paycheck to paycheck, buried in student loans. She said, "I've never seen myself as someone who could invest. That's for rich people." I told her, the moment you stop thinking like that, you start building wealth. A year later, she emailed me. She had $2,000 in an ETF, $1,000 in a stock she researched herself, and a plan to max her Roth IRA that year. She didn't win the lottery. She changed her identity. She became the kind of person who invests. And so can you. This is just the beginning of your story. Remember, 1. Stocks are for the builders. 2. Mutual funds are for the delegators. 3. ETFs are for the modern investor. And you're the architect, the author, the investor. Don't just watch another video. Take a step, and I'll see you in part 4.